Today's topic, why 5.3% is a crucial number for CPI to break away from this inflationary pressure the whole world is facing since the beginning of the year. And for today's framework of discussion, number one, we're going to discuss about why CPI have to stay below 5.3%. And number two, can we invest or trade or hedge into inflation? And before that, let's take some time to read into the disclaimer down here. All right, let's get started on the first point here, why CPI have to stay below 5.3% in the future data each month that we are looking at. And we have studied into this CPI data over the last, in this series, over the last few videos tutorial that we have. And we have kind of studied that over the last 40 years, I think the Central Bank of the United States are doing an amazing job over the last 4 decades. They have managed to cap the inflation under really good control. If you're going to draw an average line, is about the upper band is about 3%, and they are momentarily spike of about 6, but just stay there for a while. But it is about the upper band is about 3%. But over the last 40 years that we could see, but something have changed, and this became very crucial on April 2021. It have kind of broke away from this 40 years range, and it stay above 3%. And we could see that. And this orange zone is that it broke above this 30 years high, and it stayed above there. And of course, the dark orange, it broke that last 40 years high, and it stayed above. But we could see that the CPI has been range bound over the last 40 years, and this date is important, April 2021. You have break away, and it kind of formed the uptrend on CPI. And let's study a little bit deeper. And I'm zooming into the recent years. And you could literally see that the CPI has been range bound within this band. And let's look at the blue line, because the blue line will be including the food and the oil, and they are important for all of us. But we could see that April 2021 is start to break above, and the first peak it forms on the June 2021. That's 5.3. Now just imagine that for the last 40 years it has been range bound, and it kind of broke away from this range, and it formed the first peaks. Now this first peak, it is really important, and it kind of formed the uptrend. And in the uptrend, the rule is that each high, it is a higher high than the former high. And with each high, there's always market is always jagged. So there was retracement, as we could see, and it formed a new high. Now, of course, the concern is that when will the inflation be it kind of tame off? Now, then this first peak, which is important. Now, along the timeline, if months to come with CPI data, I really look forward that some month in the future, it can kind of come down and break below this 5.3, which is in June 2021. Now, we're going to come back to this CPI chart again, but let me just bring you to this cash on this US government bonds 5 years yield. It's just like it's a 5 years 10-year interest rate, you can call it. Now, let's study a little bit deeper here. And we have studied that 15 months ago in another forum that I have. And we kind of identified that there was a range bound, that we could see that. And we saw that in 2021, it kind of went up. It broke away from this long-term range, and it formed the first peak, and it come down. Then it moved up. Now, can you see that once it kind of break away from this range, it start to form an uptrend? And the characteristic of an uptrend is that each high is a higher high than the former high. Then, of course, along the timeline, how will we know that this uptrend is not in momentum? This first peak, it is important. If along the timeline, say for example from here, it start to move down and it close below this high, then I would say that the whole 5 years yield, it will lose that upward thrust momentum. But in this situation that we're seeing here is that each high is a newer high than the former high. And I would say that the interest rate, in this case, the 5 years yield, of course, you can look at the 2 years, 5, 10, 30 years, all have a very similar behavior. it broke away from the range and is still continuously moving up. And if we go back to the CPI, and that's what I meant, is that the good news will be in the future data of CPI. I hope to see that it can really come down. 7 is not good enough for me. 6 is not good enough for me. It has to come down below 5.3. When it comes down to below 5.3, it kind of broke the upward trend, upward momentum of this CPI. And of course, if that happened, I think that will bring great cheer to the whole world. And of course, the central banks still have to manage it to let the CPI come to below this range. So 5.3 is the key. And let's go back here. Now, stating for the next episode in this series, we will discuss more on the insight of inflation and rising interest rate. More importantly, how to use this knowledge, turning it to our advantage in these challenging times for all of us. Continue to explore this topic with these related videos and register for these webinars as well. Follow my Facebook page for my daily market insights. To be updated with my latest video, subscribe to my channel and remember to turn on the notification bell. See you again very, very, very soon.